What's this?
Sounds is boss team cook.
Team is cooked.
All right, hi guys. Welcome to Monarch Research Investment Challenge Workshop 2. So glad that everyone is here. I think we'll just get right into it. So this workshop will be on technical analysis. So I'll be your moderator for today. I'm from Monarch Research, Head of Operations and Logistics. So I deal with all the stuff that's related to data collection, competition, setup, and all that. And our main workshop teacher for today will be Caleb, who is the Head of Trading and Technical Analysis for Monarch. And you can see over here is a funded trader with 250,000 in capital across three proprietary firms. He's a graduate of IT and currently pursuing a business diploma at the Temasek Polytechnic. A great guy. You'll learn more about him and he'll teach you a lot of useful information related to technical trading later. Just a quick reminder on the prizes. A lot of prizes to be won for this competition. And I think these are the learning objectives for workshop 2. So you'll be learning how to analyze news forecasts, how to look for your entry after price sweeps liquidity, how to find targets after entering a trade, and tips that all day traders should pick up. And lastly, how Monarch Research actually combines fundamentals with technical analysis on individual stocks. And now will be the technical analysis lesson by Caleb. Thank you.
Hi guys, can you hear me? So no reply, I'm assuming you guys can hear me, right? Okay, I'm gonna start now. So this is Monarch Researchers Technical Analysis Workshop, hosted by me, Wong Kalem. And before we get into it, I want to make some important disclaimers. Although you guys are gonna be trading on a demo account, I'm assuming you guys are gonna take this seriously, and when you guys finish this competition, you guys want to start trading with your own money. So I'm gonna make some important disclaimers here that this presentation is for educational purposes only and does not constitute as financial or investment advice. And trading involves substantial risk, so you may lose all of the capital that you allocate. And past performance is not an indicative of future results or guaranteed returns. So you should only risk capital that you are willing to lose. Never trade with money that you cannot afford to lose. Okay, now let's get into it. What is Monarch Research? I'm just going to go through this really fast. We are a student-led equity research firm. We enable student investors and make equity research more accessible for you guys. We develop and we host mentorship programs for outstanding financial talents. So this is my introduction. I'm Wong Kalem. I'm the co-founder of Monarch Research and head of technical analysis and trading. So my background is that I just graduated from IT and I'm pursuing a diploma in business in Temasek Polytechnic. I am also a founder of Aries Studios, which is a a company within Roblox where I post accessories and I cash out that Robux into real money. And that's how I got capital into trading in the first place. And that's how I also became co-founder of Monarch Research. My current trading experience is quite wide, so I'm funded with over three prop firms already. Most notably, which is 100K with FTMO, 100K with Alpha Futures, and 25K with Quantacal. And most importantly, I survived the tariff market conditions. So now, before we move into all the juicy stuff, like how you can make $10,000 in 1 minute, it's very important to know about fundamentals because a lot of people think of trading. When I talk to you guys about trading, you guys will think about meme coins, meme stocks, GameStop, uh, but you guys don't know about fundamentals, and that's why I'm gonna be diving into that. So fundamentals, we are going to talk about the different market categories in trading. So when I say trading, most of you guys are just gonna think of meme coins or crypto or whatever, but there's actually quite a few different markets in the world of financial investing and trading. So the first one would be Forex. It is basically the exchange of one currency for another and agreed upon price. So basically that could be your ringgit to Singapore dollar. It could also be USD to Japan JPY. Could be from euros to USD. Could be from pounds to USD. So next we also have commodities like gold, silver, oil, corn, cocoa beans, wheat, etc. So you can trade all these. And by trading these, it does not mean that when you buy, like, let's say one wheat, they'll send like a barrel of wheat to your house. No, when you're trading, you're obviously trading with paper. So when you click buy, it will just appear on your screen. And then if price goes up, you make money, etc. So next we have index funds, which is what I trade personally and what I have only been trading for the past year. So what are index funds? It is basically a clump of stocks that are merged together. So for example, let's talk about the Nasdaq 100. It is basically the top 100 tech stocks in the US. So they clump that all together and that turns it into the Nasdaq 100. Or we have the S&P 500, which is basically the top 500 companies in the US, regardless of their industry. So it could be Walmart, could be tech, could be consumer and resources, etc. They'll be clumped together as long as they are the top 500 in the country. But it's not just the US, because we also have German stocks, we also have Indian stocks, and etc. So basically, all these index are basically stocks that are merged together to form one financial instrument. So next, we also have cryptocurrency. That will be Bitcoin, Ethereum, Fartcoin, XRP, Solana. So it's basically digital currencies online to make money. So, and then lastly, we have stock trading, which is going to be like your Tesla, Amazon, um, Walmart. So I don't personally trade stocks, but I do invest in stocks with Monarch. So Monarch will do their own financial evaluations, and then on my end, I'll help with the technical analysis to get the best price for this whatever stock that they are researching on. So again, Walmart, Nvidia, Amazon, etc. So now we're going to talk about market movers. So again, trading isn't just about candlesticks. We have to know that the markets actually move to financial indicators that economic indicators that I'm going to talk about right now. So we have interest rates. So high interest rates attract foreign investments, and lower interest rates can lead to a weaker currency. So basically, you have to take note of these financial data, because if you don't take note of those and you just hop onto trading and then something large happens while you're trading and you don't know why, then you're gonna feel shit, right? You guys need to research whether the financial instrument that you're trading has a correlation with interest rates or not, or whatever financial data there is. And I'm going to explain after this. So we also have economic data like GDP data, unemployment rates, inflation data, retail sales, and non-farm payrolls. Team Cook, can you unmute? Can you mute, please? Okay, thank you. So strong economic data can lead to a stronger financial instrument, and weak data can lead to a weaker financial instrument. So let's say unemployment rates are high. So that means a lot of people are unemployed. So will that stock do well? No. So you have to take note of all these economic indicators. How? I'm gonna explain that later on, but let's go through all of the market movers first. So next, we also have political stability. So political uncertainty can also cause fluctuations in the financial instrument that are trading. So for example, if Germany goes to war tomorrow, the German index, the German 40 will dump. So the example I'm going to use is actually on German politics, where last year on December, there was a lot of political instability in Germany, and that caused over here on the left, you can see that the German 40 index actually fell 300, 600 points. So you have to take note of all these news. And also, you shouldn't be trading news, because we do not have the resources or capital to be getting ourselves involved in such moves. So when usually all these news happens, I usually just step away from the charts. So the most recent example I can think of is when Trump last week announced that he was going to launch 100% tariffs on China. So we can see that the crypto market and the Nasdaq 100 dropped around 1,000 points for around 900, 1,000 points. And for me, that's usually when I step away, because after that drop, a few thousand traders killed themselves because they over leveraged their trades. What does over leverage means? It means they basically went all in the trade. They lost a lot of investors' money and they lost a lot of their own money, and they decided to kill themselves. So for me, I would rather not touch the charts or trade when all these news are happening. So moving on, we also have market sentiment. So positive market sentiment, which means bullish, can lead to a stronger financial pair, or negative market sentiment, which means bearish, can lead to a weaker pair. So you can actually check this on the fear and greed index, but I usually don't pay that much attention to it unless I am holding my trade for a really long time. But it's good to take note of. So in conclusion, when you're trading, all these fundamentals are crucial to understand the forex market and to make informed trading decisions. So all of you guys during this competition or after this competition, you guys want to pursue trading, you have to keep up to date with economic data, news events, and other factors that affect currency prices. By doing so, you guys can make informed trading decisions and increase your chances of winning in the forex market. So again, the most important part would be financial economic data. So we have economic data releases like GDP, inflation, employment figures. All these data can have significant impact on the financial markets. So positive data leads to bullish price action, negative data leads to bearish price action. I'm going to show you guys which website to check for these news and what time, and I'll show you guys how to navigate that page. So we also have central bank announcements, is when interest rate decisions can have a significant impact on financial markets. Higher interest rates can lead to a stronger financial pair and also cause bond prices to fall. Vice versa, lower interest rates can lead to a weaker currency and cause bond prices to rise. So we also have geopolitical events like wars, political crises, and conflicts, which I talked about just now. I'm going to show you guys an example right now when Iran retaliated with Israel, and that's when the US index market dropped around 300, 400 points. So another example that I can think of right now is when Russia launched its attack on Ukraine, and then we had oil prices rise, or when we had Israel attack Iran, and then we had oil prices rise because Iran has a large supply of oil. So you have to take note of all these news when you're trading because all this will affect price action. Okay, hold on, I need to drink some water. Okay, so data analyzing chart, your economic data. So for example, if the data comes out bearish, which is red, we can expect the chart to go down. But guys, I can tell you that I don't actually trade news at all, but you have to take note of all this data because if you hop on the charts and then you don't know why the chart is suddenly so bearish, then you're not trading correctly. So you guys need to take note of all these economic data, all these events, so you guys know what to look out for when you trade. So another important part would be market sessions. So trading isn't just like you wake up, I don't know, you wake up 6 a.m., then you hop on the charts, then you expect smooth price action. No, it actually moves through 3 different market sessions. So the first one is Asian market session, which takes place from 8:30 a.m. to 5:30 p.m. And we also have the Europe market session. We call it London session. That would be 3:30 p.m. to 12:30 a.m. And then my favorite, the one I personally trade, would be the New York market, which opens on 9:30 p.m. and closes at 4 a.m. So some things you need to take note here is that we have overlappings of sessions also. Like at 3 p.m. it overlaps, Asia and London overlaps, and at 9:30 p.m. Europe and New York sessions overlap. So what does overlapping mean? That usually means that price can be very volatile when that timing comes because that nation or that continent starts to trade, starts to pump in volume into the markets. So for an example here, Asia session is usually really slow because we do not match the capital to Europe and America. So you can see Asia's price action is really slow. We only move 100 points in NASDAQ, and then London only moved maybe 90, 100 points compared to New York, where we had a lot of action here, a lot of clear price action, where it moved like around 400 points. So you can catch a lot of trades here because there's going to be a lot of volume, there's going to be a lot of clear moves compared to Asia and London. Actually, that also depends on what financial instrument that you trade. If the financial pair that you're trading is a company based in Asia, you should probably trade Asia. If not, if it's in the US, then you should probably be trading US session instead, because you do not want to be caught in slow price action when you trade in Asia and London. You guys do not want the extra pressure holding your trade for an entire day, because the entire point of trading is to get in and out really fast within maybe 2 or 3 hours. You're not supposed to slave away at your computer screen. Okay, so in conclusion, market makers are events or data that have a significant impact on the financial markets, and you guys must keep up to date with market movers and events to make informed trading decisions. By doing so, you can increase your chances of winning in the financial markets. So part two, let's get to the juicy part, which is the concepts that I personally use. Okay, so again, these are called ICT concepts, called inner circle trading. You guys can learn it on YouTube for free, but I'm gonna give you guys an introductory to all these strategies and concepts. So the first one would be fair value gaps and imbalances. I usually use all these concepts in my own trading. I don't trade a single concept individually. I actually put all these concepts together to find my entry and take the trade. So for this example, we have a fair value gap. It is also called an imbalance, but what it is basically when price pumps or dumps, you usually leave a gap here, a gap that is formed when there's a wick here and there's a wick here, and then there's just a huge body candle over here. So this is what's called a fair value gap. So for this example over here on the left, this is a bullish fair value gap because it pumped up and then created a bullish gap over here. I'm gonna explain how to utilize these gaps later on, but let me just go through the intro first. So we also have bearish fair value gaps is when price dumps and creates an imbalance here. The same concept here, but this is bullish and this is bearish. So for a clearer picture, a better example would be over here. So we see price pump over here making a bullish fair value gap, which is also an imbalance. So what the market needs to do is to come back into this gap to rebalance the market so it can then take out liquidity over here. So if it's bullish, it will retrace back and then go back higher. And we also have bearish fair value gaps where the same concept as bullish fair value gaps, but then this one is the price will go down. So we created a bearish fair value gap here. We can see price retrace and tap back into this fair value gap, and then it'll dump again to take out your target over here. So if you want to be trading this strategy, let's say you put your buy order over here and then you target over here so you can win. Or over here, uh, okay, another misconception I get when people first start trading or investing is that when prices go down, you lose. That's not necessarily the case. Let's say that you place a short meaning that you bet the market is going to go down. And then for this example, the price actually goes down. You actually make money off of that trade. But if you place a long, and price goes down, then you lose the trade. Or similarly, if you place a short, you predict that price is going to go down, but price goes up, you lose money. So that's trading. It's not just buying and buying and buying. You can figure out whether the market is going to go long or short. So that's how you make money from trading. So next we have liquidity pools. Liquidity pools are basically where people put their stop losses, where people decide to exit the trade and lose their money when they get into trading. So let's say Timothy buys the Nasdaq 100 over here, or he shorts the Nasdaq 100 over here because there's a resistance. This is what people call support and resistance, but to me, I look at it as liquidity. So let's say Timothy shorts the market over here, and then Tim Cook shorts the market over here. So there's stop losses resting above these highs because people shorted the market here, right? And then some support and resistance traders will say, oh, there's one tap here, there's two tap here, and there's three taps here. So that means if it taps the fourth time, it's going to go down. So people will place shorts. That's not necessarily the case. We can see what price does is that once it taps the fourth time, people will go for shorts, right? But what price actually does is takes out all the dumb money traders, takes out their stop losses over here, and then they collect money, and then they make the move down. So what liquidity pools tells us is that when price takes that stop loss, it'll go to the opposite direction. And this is how I perform in my own trades. So for example, over here, instead of looking at this as resistance, I look at it as liquidity. So when I see these types of liquidity zones, I mark it out as buy side liquidity. And then if it's at the top, it's buy side liquidity. If it's at the bottom, it's sell side liquidity. This is all the time. So if it's at the top, it's buy side. If it's at the bottom, it's sell side. So for example, we see price take out all the stop losses, take out buy side liquidity, and then we take an inverse fair value gap as your entry for a move down to take out sell side liquidity. So basically, if price takes out buy side liquidity, you can trade to the opposite direction, and then your target would be sell side liquidity. But let's say if price takes out sell side liquidity first, you can target buy side liquidity. So for me, trading is just looking for where people's stop losses are, because the market is doing one or two things. Most of the time, it's either rebalancing the market or it's going for liquidity pools. So we also have different types of liquidity. We have 7 types of liquidity. These are not ranked. It's not in any order. So first, we have relative equal highs and lows. Second, we have equal highs and lows. Third, we have low resistance liquidity. Fourth, we have previous day highs, previous day lows. Fifth, we have new day opening gaps and new week opening gaps. Six, we have London and Asia session highs and lows. And seven, we have data wicks. If you guys can't catch up with me, don't worry, because I'm going to go in depth to each of these categories. So first we have relative equal highs. So relative equal highs means that all these stop losses are placed really close to each other, and all these short sellers are their position will get stopped out if price goes up this direction, and all the stop losses are relatively close to each other. So what can you expect price to do? You can expect price to take out liquidity so you can trade to the opposite side. Because what the normal retail trader will see is that, oh, since price is going down, you know what? I'm just gonna short the market. I'm gonna make $10,000 today. No, what the market will do is actually sweep out all these short sellers, take out liquidity, and then they go to the opposite direction. Because before the market moves, it needs liquidity to move. So these are relative equal highs. Again, basically it's highs that are close to each other. And then we also have relative equal lows that are basically the opposite of relative equal highs. So equal highs are placed at the top, and then relative equal lows are placed at the bottom. So similarly, if price wants to move up, you can't expect price to not take out liquidity first. So for this example, we can see price take out all these sell side liquidity, take out all that stop losses, and then trade to the opposite direction. This is where you can capitalize on your trades. So next we have equal lows and equal highs. It is similar to relative equal lows and highs, but this time it is a stronger drawn liquidity because they are right beside each other. So when you see equal lows and equal highs, you can 100% expect market to trade towards it. So for equal lows, for this example, you can see that equal lows will form here. What price will do is sweep out equal lows, create your inversion, and then you can trade to the opposite direction and collect buy side liquidity over here. And then we also have equal highs, where equal highs are made in the market. So people put their stop losses here. What price will do is sweep out equal highs and then make a move to the opposite direction where you can capitalize on your trades. So this is a long example. You long the trade and then you win. And it's a short example. You short the trade and then you win. So next we have low resistance liquidity, which basically means that when there's low volume and price just drops, it creates all these low resistance liquidity that are just resting below. So what you can expect price to do is to sweep this out really fast. So all these moves, especially for low resistance liquidity, happens really fast because they are really close to each other, and there was absolutely no volume when when liquidity was generated during this time span. So what price will do is sweep out all this liquidity and then trade higher to the opposite direction to take out buy side liquidity over here. So next we have time-based liquidity like previous day highs and previous day lows. So what previous day highs and previous day lows means, okay, let me show you guys an example. So let's say on the Nasdaq chart, right, on the daily time frame. So we have different time frames on trading also. We have 1 minute, we have 2 minute, 3 minute, 4 minute, 5 minute, etc., all the way up to the monthly or yearly time frame. But for me, the max I use is up to the weekly time frame. So let's go to the daily time frame, for example. So yesterday, the highest price it went was over here, right? And the lowest price that yesterday went was over here. So if, let's say, price today takes out previous day highs, you can expect price to go back down to previous day lows. Or vice versa, if price takes out previous day lows, you can expect price to go back up to previous day highs. So you should always wait for one of those to get swept before you enter your trade. So that is for previous day highs and previous day lows. And then next we have new day or week opening gaps. So this example is really recent because last Friday, Trump announced his tariffs on China, and that caused a huge dump in the market. But during the weekend, he actually renounced all those tariffs. So on Monday, price pumped up crazily. Sorry. And that makes a new week opening gap. So what's the difference between like a new day opening gap, new week opening gap compared to a fair value gap? Usually for fair value gaps, you see that will be at least a candle here, right? But for this instance, it's legit just a gap. It's in empty space. So we call these new day opening gaps or new week opening gaps. So how you can utilize all these gaps is that you can expect price to go back into these gaps to rebalance the market. Because if there are gaps in the market, what the market movers want to do is to come back down to these gaps to rebalance it. So for this example, you can see price sweat out, liquidity over here, liquidity over here. So you can take your inverse fair value gap over here to take shorts to that new week opening gap or new day opening gap. And then if you have the balls, right, after trading back down to this gap, the market is going to react off of this gap and make a move higher. Then maybe you can trade off of that too. So that's it for new day or week opening gaps. And we also have data highs or data lows. So all these are really important because going back to fundamentals, when we talk about economic data releases, this is an example, a good example of how market moves based on all these economic data releases. So you can see once a data comes out, and then in this instance is bearish, right? We can see there's this huge abnormal candle that was formed on 8:30 p.m., which is usually the timing when all these economic data are released. So we can see all these huge data candle form on data releases. But how you can use this to trade is liquidity again. So when this move happens, there's going to be liquidity below and above that candlestick. So we call the ones on the top data highs and the ones at the bottom data lows. So how do you utilize this is when price, let's say price takes out data lows, you can expect price to go and take out data highs next. If price takes out data highs first, you can expect price to take out data lows next. So for this example, price took out data lows, you look for your entry model, you take your longs to target data highs and you win in the trade. So I'm gonna explain to you guys how to find your entry, because I noticed that I've been saying a lot of inverse fair value gaps, but you guys don't know what that means. But first, you guys need to understand the targets in the market, the liquidity zones to target, and for key levels to hit first. So yeah. So next we have inverse fair value gaps. So what's the difference between inverse fair value gaps and normal fair value gaps? Fair value gaps, again, it'll respect price and then go higher. Let's say for bearish fair value gaps, it'll respect this bearish block and then go down lower. But for inverse, so let's say on this example, price moves up and then creates a bullish fair value gap. People are gonna expect price to go back into this fair value gap and then trade higher, right? Wrong. What inverse fair value gaps means is that it disrespects this bullish fair value gap completely, and then that gives you a signal to trade to the opposite direction. So I don't strictly use fair value gaps for my trades, but I use instead inverse fair value gaps. For me, fair value gaps are just to see whether price is respecting bullish or bearish order flow. So for this example, we can see that price disrespected this bullish fair value gap close below it, so you can trade to the opposite side to take out sell side liquidity. So a clear example would be over here. If we put everything together, right, we see 4 equal highs over here. So what price did is sweep out highs here and then swept out highs here. And once it did sweep out the highs, it will usually create an imbalance here, which is the fair value gap, right? But then a lot of people will expect price to go back down here and then move higher. Why? Because people see it move higher. So you know what, if it taps into this fair value gap, I'm gonna buy. But what I see is that once it takes out the buy side liquidity, it's going to go to the opposite direction. So I take my IFVG inverse fair value gap entry to take shorts to sell side liquidity over here. So again, price takes out liquidity here and here, creates an imbalance, and then trades and disrespects that fair value gap, creating an inverse fair value gap where you can take shorts and then target sell side liquidity over here. So now I'm gonna talk about how I do my trades. And what if I told you guys that I got funded with $225,000 in 3 different prop firms just by using a systematic ICT trading model, and it is so systemized so anyone can copy it, especially you guys. So after months of backtesting and refining and live trading, I finally stuck to this system that's easy to learn, execute, easy to adjust, and it's proven to have a 60% win rate over 2 years of backtesting data if used correctly. If you guys want this data, I'm gonna send it into the chat so you guys can have fun with it. And then so I'm gonna be talking about the 4-step model that I use daily. So I'm gonna show you guys in order to take high probability trades that made me 5 digits this year. So you guys do not want to miss this out because you're gonna overcomplicate your trades and watch the wins slip past you. So first, I determine my higher time frame bias. So that basically means we want to understand how the market is moving on a higher time frame trend, so we can align that with our lower time frame entry. So many people skip this step and then they'll jump into trades without knowing if the higher time frame is bullish, bearish, or just consolidating. So this leads to a lot of inconsistent profits. Like they'll take one win or one loss and then they won't even know why. And then they'll second guess themselves. They'll get manipulated out of trades because they don't understand where the higher time frame is going. So if you're not checking the higher time frame, you're basically trading blind. So I'm going to show you guys how do you check your higher time frame bias. So before I trade, I usually ask myself these two questions. Is price delivering from buy side or sell side liquidity? So if price is delivering from buy side, it's going to go to sell side next. If price is delivering from sell side, it's going to go to buy side next. So for example, over here, let's say price opens and then takes out previous day lows over here. Right, price opens, takes out previous day lows, creates a bearish fair value gap. But again, what liquidity means is that once this gets taken out, you don't trade below, you trade to the opposite direction. So once price takes out previous day lows, you wait for this bearish fair value gap to get inverse, disrespected. So this is a clear sign that price is switching from bearish order flow to bullish order flow. Right, so let's say this bearish fair value gap gets inversed, and then it respects this bullish fair value gap that was just formed over here. Right, so you can if you see price respecting this bullish fair value gap, not inversing it, you can expect price to then take out buy side liquidity over here. So you can basically place your trades from here and then target buy side liquidity, maybe your stop loss resting in that fair value gap that you traded within. And then vice versa for from buy side liquidity to sell side liquidity, we have, let's say, equal highs over here. Price takes out equal highs. Equal highs are formed here. Price manipulates and takes out equal highs, and then it disrespects this bullish fair value gap and respects a bearish fair value gap. You can then expect price to be switching from bullish to bearish order flow, where you can then take out sell side liquidity over here. So again, bullish means it takes out sell side liquidity and then disrespects bearish PDAs and then takes out buy side liquidity, and then bearish means that it takes out buy side liquidity first and then respects bearish order flow, then you can trade to take out sell side liquidity next. So if price goes down, you trade up. If price trades up, you trade down. Okay, so that's the most basic way I can put it. So the next step, which is finding out how to find your key levels. So you have to find out where the market is going to be bouncing from so you can have a clear level to anchor your bias and build an entry point around that bias. So if you skip this, you're going to miss out on a lot of trades that look good, and then you get manipulated out, and then price will run to your take profit. So how do you actually find your key levels? We have a lot of different time frames for key levels. Hold on. We have key levels that are formed on the 5-minute time frame, 15-minute, 1 hour, 4 hour, daily, and weekly time frames. So you're gonna want to be looking at these time frames for key levels. You have to see whether price rejects or bounce off of these key levels. So I'm going to be talking about all these key levels. One, we have fair value gaps, which is basically, for this example, it is basically a gap that was formed by the market. You can expect price to retrace into it, and then you can place sells to sell side liquidity over here. So okay, so we also have intermediate highs and intermediate lows. So just now I explained to you guys the concepts of fair value gaps, right? But now we also have intermediate lows and intermediate highs, which are basically liquidity that are made within those fair value gaps. So let me give you guys an example. Let's say a fair value gap, a bearish fair value gap was created here. So what price will do is trade back into that fair value gap and then trade lower, right? But now what is made over here? This is called an intermediate high. It is a liquidity zone that is resting within a fair value gap. So intermediate high. So what you can expect price to do then would be to trade back into this intermediate high, take out all these stop losses resting within this bearish fair value gap, where you can then trade lower and then target sell side liquidity over here. Similarly, for intermediate lows, let's say a bullish fair value gap gets formed over here, right? Price moves up, creates this bullish imbalance, and then price trades back into this bullish imbalance and then trades higher. So now what's resting in this fair value gap over here? An intermediate low. It is a liquidity zone again, right? So let's say an intermediate low is resting within this fair value gap, and then you want to trade higher. But what you want to do is to wait for price to take out liquidity first, right? So for this instance, the intermediate low would be your liquidity zone, your key level to target off of. So price is going to take out this intermediate low where you can then trade higher and then target over here, and you win in the trade. Okay, so that's it for intermediate highs and intermediate lows. So next we have previous day and week highs, which is what I explained just now. If price takes out yesterday's high, it will probably trade to yesterday's low. So if price takes out yesterday's low, you'll trade to yesterday's high. So remember, trading for me is all about trading to the opposite direction. Okay, then we also have London and Asia session lows. Remember just now how during fundamentals, I told you guys that there are three different trading sessions. We have Asia, we have London, and then we have New York. So liquidity can also be made during Asia and London. So let me show you guys over here. So the indicator that I use to determine Asia lows and London lows, or Asia highs and London highs, is called ICT kill zones plus pivots. This stream is recorded, so don't worry if you guys missed this out. Again, ICT kill zones and pivots, it basically shows during that Asia session, the lowest price it went and the highest price it went. Or during the London session, the highest price it went and the lowest price it went. So how you trade these zones is that, let's say price manipulates and takes out London lows, right? You can then expect price to react off of London lows and then take out Asia highs next. Or let's say price takes out Asia highs first, you can expect price to take out London lows next. Right, so all these are time-based liquidity, and those are usually also really strong draws on liquidity. Okay, so next we're gonna go to the third step, which is how to identify the manipulation leg. So you have to take note of how price reacts when it hits that key level. So let's say price hits previous day highs, right? A lot of you guys are not gonna be patient. You guys are just gonna short because, oh, Caleb said if it hits previous day highs, it's gonna go with previous day lows next. But that's not usually the case sometimes. You need to find confirmation and you need to mark out your manipulation leg. So you guys need to understand where that manipulation leg is at that key level. So if you skip this and you just take random trades, you will confirm get stopped out early and then you watch the trade play out without you. So how do you identify that manipulation leg? So you want to mark out the low to the high of that manipulation leg that hit your key level. So a live example here that I can show you guys, a trade that I took recently is that price took out previous day highs over here and took out New York PM session highs. So again, if price takes out highs, it's going to go lower. So we see price took out highs, react off of it, and created, what's this? A 5-minute bearish fair value gap. So we can see price trade into this fair value gap, chop around it, and then create liquidity. So all these are low resistance liquidity because they are really close to each other. So what can we see price do here when New York opens? It actually sweeps out liquidity while respecting this 5-minute bearish fair value gap after taking out previous day highs. So after that, I look for my inverse fair value gap to take shots off of and target sell side liquidity over here. So again, your manipulation leg is that leg when price takes out previous day highs or whatever key level that you mark. So for this instance, price takes out previous day highs, creates a 5-minute bearish fair value gap, price retaps into it, chops into it, and then takes out intermediate highs, a high that is placed within this 5-minute bearish fair value gap, and then you can trade this imbalance, create an IFVG and trade lower. So for inversion fair value gaps, right, you guys have to take the highest inversion fair value gap. So let's say you see a 1-minute fair value gap that you expect to inverse, but then there's a higher time frame 3-minute fair value gap, right? You don't want to inverse that 1-minute fair value gap and then take shots. You actually want to wait for the highest time frame inversion. So for this example, it was the 2 minutes. So let's say if I took a shot and then this was a 1 minute, but then there was a 2-minute fair value gap that is still respecting, price is going to this respect that 2-minute and then take out my stop loss. So you guys want to be switching from the 1 minute to the 5 minute to see the highest time frame where price is going to inverse that gap. So next we have really important. Next we have my favorite draws on liquidity. You guys need to know what to target. You guys have to understand all the draws on liquidity that are made in the market. without knowing all these draws on liquidity, without understanding them, you won't know where and when to exit your trade. So I'm going to go through all my favorite draws on liquidity in the market so you can have these target points to exit your trades when you trade with my model. So here are the best 8 targets that I use every day. And again, these aren't ranked. I actually went through this just now, but I'm going to recap this again for you guys. So first, we have relatively equal highs and relatively equal lows. So for this live example over here, we can see price trading up and then it's generating all these relatively equal lows. So what the normal person would see is that since price is creating equal lows, since price is moving up really slowly, I'm just gonna long in the market, I'm just gonna buy in the market and then expect price to go higher. But since there's a lot of really close liquidity areas for price to take out, you can expect price to actually trade against this and then take out all this liquidity here. So again, those are for relatively equal highs and relatively equal lows. And next we have equal highs and equal lows, which is basically the same thing as relative equal highs and lows, but this time they're just really side by side each other. So there are stronger draw on liquidity. And next we have low resistance liquidity. It is when price is just chopping with low volume and creating all this liquidity. You can expect price to then sweep and take out all this liquidity really fast. Again, for low resistance liquidity, the moves happens quite fast. And then next we have previous day highs and previous day lows. It is time-based liquidity. So if price takes out previous day highs, you can expect to wait for an inversion model to take your shorts to previous day lows. If price takes out previous day lows and then respects bullish fair value gaps, you can expect a bearish fair value gap to get inverse, so you can take longs to previous day highs. And then next we have new day opening gaps and new week opening gaps, which I went through just now. And then we have London and Asia highs and lows, which is what I went through just now. It is basically time-based liquidity, where let's say price takes out Asia highs, it will probably go for Asia lows or London lows next. If price takes out London highs, you'll likely go to the opposite direction to take out London lows or Asia lows next. And next we have data wicks, which is basically candlesticks that were generated when a really important economic data comes out. So for this example, again, let's say this huge abnormal candle was formed and then price takes out data lows first, you can expect price to trade to data highs next. So if price takes out data highs first, you can expect price to trade to data lows next. And then next one, this one I didn't explain just now because you're gonna have to understand previous day lows or resistance levels, liquidity levels, and your inversion fair value gap first to understand this. So what this means is that you can actually target unfilled 5-minute or 15-minute gaps. You don't have to just look at it and see whether price is respecting it or not. Sometimes you can trade towards it. So for this example, right, price takes out previous day lows over here. So what I did was I waited for a reaction off of previous day lows, and then there's a bearish fair value gap that was formed over here, which price disrespected, turning it into what? Turning it into an inversion fair value gap, where I can take longs, and since I don't have any further targets here, and the best target would be this unfilled 5-minute or 15-minute gap. So I took a 1-to-1 ratio, risk to reward ratio here, and then I made 1K on the day. So what a risk to reward ratio means is that, let's say I risk 1% to gain 1% on its trade. So it depends on your account size too. So for you guys trading this competition, your account size is 1 million, right? So let's say you're risking 1% to get 1%. You're risking 10K to get 10K. Or let's say for this trade, you're risking 1% to get 2%. So that's basically a 1-to-2 ratio risk to reward. You're risking $10,000 to get $20,000. Or for over here, this is 1-to-3 risk to reward ratio. You're risking $10,000 to get $30,000. So again, it depends on your account size. So if you're only trading with a small account, you're only trading with a $100 account, you make a 1-to-1 risk to reward trade, you're only making $1 on the trade. So, and then the next important point I want to bring out is that you want to target trades that have good risk to reward. A good risk to reward means that you're targeting a risk to reward of 1-to-1 or 1 to higher, right? You don't want to target trades where you're risking $10,000 to only get $3,000, or you're risking $1,000 to only get $180. So you don't want your trade to look like this. You want your trade to look really good like this, right? Okay. So those, I just finished going through the best targets that I usually target for my trade, for my trading sessions myself. And then lastly, I want to go through the 3 important rules that I would like to bring out to boost your win rate. So if you don't follow these 3 rules, your win rate will tank. I used to lose a lot of trades trading this model, but after months of refining the model, I found these 3 rules that boosted my win rate like crazy. So the first rule is do not trade against equal highs or equal lows or low resistance liquidity. What I mean by that is like, let's say your target is buy side liquidity over here, and then price inverses this fair value gap. So what you're gonna do, because Caleb said, oh, since price took out, let's say previously lows here, and then it inverts this fair value gap, I can take longs to buy side liquidity over here. But what you guys are not seeing, and what I didn't see last time, is that price actually generated a lot of low resistance liquidity before inversing this gap. So when that happens, you can expect price to sweep out all this low resistance liquidity and then take out buy side liquidity. So again, if price creates low resistance liquidity but inverses this fair value gap, you should not take longs to target buy side. You should instead wait for price to sweep out all these low resistance liquidity first, and then you can trade higher to buy side liquidity. Or let's say a really good way of showing this, let's say price does take out sell side liquidity first and then creates a clear move to the upside, right? And then inverses this fair value gap without creating a low resistance liquidity. You can then expect to take longs, and then price will take out buy side liquidity. So again, this is a clear move and you should take these. But if price is moving like this, you should not take this, but instead wait for price to sweep out all these liquidity and then go up. So similarly for equal lows and equal highs, you should not be trading against them. So if equal lows are formed but creates an inversion fair value gap, you should not take longs to buy side liquidity. You should instead wait for price to sweep out equal lows and then trade to buy side liquidity. So again, don't trade against equal highs, equal lows, or low resistance liquidity. And then the second rule that I made for myself is only trade New York session, which is 9:30 p.m. to 11 p.m. Why only trade New York? Because I'm trading the NASDAQ 100, which is the top 100 tech stocks in the US economy. So I can't be trading NASDAQ 100 on Asia session or London session, because that's usually when there's the lowest volume in the market, and I don't want to be spending the entire day staring at the chart and trade Asia or London. So also there's daylight savings soon. So New York, instead of opening at 9:30 p.m., New York session will actually start at 10:30 p.m. and I'll end my session at 12 a.m. And I told you guys that New York sessions actually ends at 4 a.m., right? But actually what I do is I only trade from 9:30 to 11 p.m., where there's that highest volume for New York session. So if I don't find a trade within this 2 hours and 30 minutes, this 1 hour and 30 minutes, I probably won't take any trades at all. If I don't see any setup, I'm most likely not going to take a trade. So you're supposed to take care of your capital. Don't just take trades because you haven't been in one on that day itself. You want to take the most A plus setups. You want to make sure that before you take that trade, you want to make sure that the trade meets all of your requirements. By that I mean it takes out liquidity, has a strong target, creates your inverse fair value gap, so you can take that trade. If none of those happens, you best don't take that trade, because you'll be risking your capital for a low probability setup. And then the last rule I made for myself is 1 trade per day. Just risk 1% of your account. For the analogy that I'll use for this competition is, let's say a competitor makes 5% in one day, and then he gets overconfident, and then he trades tomorrow and he takes three trades, which loses him 2% in each trade. So he makes 5% today but loses 6% tomorrow. So he's basically down -1% for entire competition. Compared to you, let's say you take 1 trade per day and for 5 days in a row you win. So you are basically up 5%, while the guy that was overconfident, too greedy, he loses 6%. So you're basically up against him by 6%. So again, take 1 trade per day, make sure it's an A plus setup, and risk 1% of your account only. Yeah, so if you guys follow all these steps and all these rules, and you guys just stick to the system, you guys can confirm start seeing results right away, like my friends Kaydin, Javier, and my trading partner Amir. So once you guys get your eureka moment for this trading model, you guys are gonna start making some sick profits right away. So yeah, that's it. So I hope you guys have learned something about me and how I place my trades on the NASDAQ 100. So I'm going to provide some useful links over here. So again, Forex Factory to view economic data, Bloomberg to view news and political events or economic events, and then Financial Juice for real-time events that happens. Let's say like Trump says there's tariffs on China. Again, you can see that from Financial Juice really fast. Yeah, so that's the Q&A section. Please hit me with your best shot.
All right, thanks for the lesson, Caleb. All right, guys, we'll now be moving on to the Q&A session. So if you have any questions you would like to ask, feel free to put it in the chat, and we have this session for around 5 to 10 minutes. Right, if there's no questions at around the 1 to 2 minute mark, I think we'll continue. But please, any questions, guys?
One question by Ethan here. Could I clarify if this competition is focused on intraday trading or is swing trading allowed? I'm pretty sure all types of intraday trading, swing trading, scalping is allowed, but for this model, you'll be scalping actually on the 1 minute time frame on the Nasdaq 100. For this competition, you'll be trading ETF of the Nasdaq, so you'll be trading the QQQ instead. Can we just analyze it so systematically like this without considering the news? You guys have to consider the news. So let's say New York session starts at 9:30 p.m., right? But news comes out at 8:30 p.m. I don't trade on 8:30 p.m. I wait for that economic data to come out first, and then I come back to the charts and then I see where price is going to deliver after the economic data is released. How do you determine a fair value gap? Okay. So again, a fair value gap is made when there's a huge imbalance in the market. So let's start off with bodies and wicks. So this is the candle's body and this is the candle's wick. If there's a gap between this wick and the next wick after this candle, this is considered as a fair value gap. Oh, cannot see. Wait, can you guys see? Wait. Yeah, let me go through this again. So let's say this is the body's candle, right? This is the candle's body, and then this is the candle's wick. And then let's say on the candle after this candle, and then there's a huge body over here, and then there's a wick formed over here on the next candle. This is a fair value gap. This huge body over here is a fair value gap when there are no wicks overlapping each other. Yeah, no worries. You can actually Google fair value gap also. All these concepts, I have to tell you guys, I'm not gonna gatekeep. It's free online, bro. So you can go on there and then if you guys are not sure or not clarified on what I'm talking about, yeah, please go ahead, go online, go on YouTube. It's all online. I learned this entire model for free online also. So yeah, that's the magic of internet money. Have you ever tried to automate your model to save time? Oh yeah, I actually I'm doing it right now. Yeah, so yeah, I have tried doing that and I'm doing it right now. How do you determine for yourself if a news is already priced in or not on your trades? Okay, so there are different things that can get priced in or not. So for economic data, no one can price that in. So like just now, I showed you guys there was this huge abnormal candle that was created when there was news, right? Okay, let me go back to that. So over here, no one can price this in because it only comes out on the time itself. But for let's say economic events like let's say Trump announced tariffs, you can't expect that to be priced in. So if you see price reacting crazy bearishly from the news, you should wait for price to take out some sort of liquidity zone so you can see if price reacts that liquidity zone to move higher. Because usually when Trump says all these kinds of things, it's usually spreading fear in the market. So it gives the market makers an excuse to sweep out liquidity before going back up to the level it was before. So I can show you an example, right? So most recently, the Nasdaq 100 went back to all-time highs over here after Trump's crazy announcement on tariffs over here. But I already told my friends it's probably already priced in. On the next week, they're gonna buy it all back and then price swept out liquidity over here. and price swept out liquidity over here and then reacted off of it to trade higher back to all-time highs. So when all these news happens, don't fear and don't trade. You have to monitor what price is going for so you can trade back up to that level. How do you start learning? So I had this really great mentor. So I started trading when I was in ITE. So I had this great mentor. He was actually teaching me support and resistance, um, indicators for like EMA, exponential moving averages. But I completely don't trade those concepts now. I started learning my own concepts. But he was a really great help because he actually taught me about a lot of fundamentals. So if not for him, I would be still trading meme coins. So I actually started learning trading from him. So I can actually I can give him a shout and I'll put his Instagram username. It's called Easy Flows. Yeah. So is there a framework you use to determine if some news is priced in? Okay, so the framework that I use is when some sort of political or economic data or event comes out, I'll just wait to see if price takes out liquidity and then reacts off of it. If price takes out liquidity but then goes further down, you can expect price to go further down again. So the framework I use is seeing where price reacts off of. How long do you do paper trading before doing it with your own money? Okay, so I started paper trading in April of 2024. And when it was 2024, I was still 17, so I couldn't open any brokerages or get funded in any prop firms. So from April all the way up to September, I was trading on paper accounts. But I can tell you, bro, paper trading and actual trading is completely different. So even on paper trading, let's say you do follow rules, you follow consistent rules like risking 1% or one trade per day. When you start to move into real money, it's going to start to affect you psychologically. But it's not a losing game, okay? You guys can actually train your psychology to stop getting affected from trading with real money. So again, all this takes time. This isn't a get rich quick scheme. So for me, it took maybe 6 months to do paper trading, and then I started to do live trading with my own money for around maybe 1 year now already. So irrelevant to the conversation, but just wanted to ask, how do you see these concepts being applied to other financial markets like equities? Okay, really good. Okay, so I'm the co-founder of Monarch Research. So I help my friends do stock picks. Can you guys see my screen? Help my guys do stock picks by using really easy concepts. These are the concepts that my mentor actually started to help me with. So it is completely different from ICT. There's no fabric gaps here. There's no liquidity zones here. But since it is individual stocks, it is really easy to spot. There wouldn't be that much manipulation. There wouldn't be that much liquidity sweeps. So an example I'm going to use here is Walmart. Actually, let me go through the slides first because I did present this before. So for individual stocks, I use Fibonacci retracements. So Fibonacci is basically this mathematician that found out that these series of numbers have correlated 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 factor in it. And that's when the market started using Fibonacci retracements in their own financial markets also. So for this example, what you want to do with a Fibonacci tool is put it on a swing low to the swing high of the most recent upswing. And then you can expect price to retrace into these key levels. For these key levels, that will be the 61.8%, 50%, and 38.2%. You can expect price to trade back into these levels where you can place your long and then price will go to the opposite direction you're trading with. So pairing this with Fibonacci, you have to make sure that you can see market structure. So if price is trending down, you cannot be looking for bullish moves through Fibonacci. You should be looking for bearish moves instead. So for example, over here, price is making higher lows and higher highs, higher lows, higher highs. You should not be looking for shorts here. You should instead be looking for longs. Or vice versa, if price is going down, making lower highs and lower lows, you should expect price to be trading continuation downs. Okay. Okay, so let me go back to Walmart as an example, right? So this was a trade that we did release on paper a really long time ago. I think it was in April or March of this year, and it played out perfectly, right? Okay, replay going all the way here. Right. Okay, let's say there's a swing high over here. So you place your Fibonacci. Okay, let me delete all these things. Okay, there's a huge bullish move over here from this gap, right? So you can use your Fibonacci retracement tool to draw it from the body to the wick of this swing high. So I'm gonna open the settings and you guys can please take a screenshot or go through the recording again. These are the key levels that I use for my Fibonacci retracement tool. So what price does is once you wait for price to retrace back down into these levels, you can then place your longs, your buys, and then price will eventually play out and then hit your take profit here or here. And then next is smart money concept. So basically it is similarly to Fibs, but it complements Fibonacci. So what the smart money concept is that once it hits all-time highs, people don't know where price is going to go next, but this tool actually helps us traders determine where price might go next. So how do you use this tool? Is the same as Fibonacci, but there's one extra move. So it's the same way you place your Fibonacci from the bottom to the top of this swing high, and then you drag it down all the way to 0.618 over here. So you can then determine more levels that were never touched by the financial instrument. So you can then target over here. And moving forward, this trade absolutely played out perfectly. We hit take profit one already, but this will take a while. Again, this is on the daily time frame, but we have seen great results with this model. So next we have CoCom playing out perfectly, swing low to swing high, price retraces, you place your buys here, you target over here. Navios, perfect also. Amazon is also good. This IHH Healthcare was insane. PayPal for shorts, for vice versa for shorts, you want to place from the high to the low, right? Then price retraces here, then you place your shorts. Okay, so I had a lot of haters when I was doing this because they were saying, you know what, since I'm trading fundamentally, why not I just follow the fundamentals and I just blindly place my trade based on the fundamentals, right? So Monarch Research actually released this PayPal short document over here when price was over here. So if we had placed shorts over here when we published that paper, we would have gotten stopped out. But then I did my research, my technical analysis, and I realized the best price to short was over here. And price was so precise, it actually hit this level, traded to take profit one, and actually you can see there's a reaction over here. So yeah, all these works. So yeah, I mean, I can show you some losing trades also. It's not all sunshine and rainbows, but the best part is that's when risk management comes into play. You only risk 1% for this trade, or you make a lot more on these trades where you're winning. So I can show you a couple of successful close trades that we did. So it was a short on Crocs, it was a long on Platinum. This had a crazy run. We had a short on Rigetti over here also, which hit take profit one over here. We also have longs on Sibanye Stillwater, which is a mining company. And we also have Under Armour shorts. This one didn't play out. And then we also have awaiting entries and entries that left. Yeah. So that is how I. Okay, do you use indicators? If so, do you trade? Togi said, do you trade options? No, I don't trade options. I only trade futures and forex. Then K-Bin said, do you use indicators? If so, which ones? Okay, so I do use indicators, but it is nothing like, let's say, lines or moving average indicators. It is to see time-based liquidity. So again here, time-based liquidity like Asia lows and Asia highs, London lows and London highs. So this is called ICT kill zones and pivots. Sometimes I use equal highs and equal lows, but I rarely use this anymore because I can just spot it on my own. But for time-based liquidity like Asia lows, Asia highs, I will use ICT kill zones. This is just to see whether price takes out liquidity and reacts off of that or not. So for example, over here, we have a live example right now, actually. Price took out Asia lows and is reacting bullishly, and it's likely going to take out London highs next. Yeah, so that's the only indicator I use when I day trade.
All right, thanks, Caleb. I think that's all the time we have for Q&A. Thank you guys for sharing such insightful questions. And thanks, Caleb, for answering them
No
so
worries.
well. Thank
No
you,
worries,
Caleb.
guys.
Alright, so guys, our next workshop date and time will be on 29 October, 7 p.m. You can expect to learn more on market outlook and how another established trader analyzes stocks. This is by Tiger Brokers Chief Market Strategist James Wee, who has a Bachelor of Business in the University of Technology and is also a SGX Academy trainer, a stock market commentator for a lot of proven business channels like CNBC, Bloomberg, and more. Alright, and now for final part, the photo taking. So if you guys don't mind, if you guys are out, don't mind it at all, please feel free to on your video cam so that we can have a quick photo taking.
Come on, guys. I want to see my friends.
This is a quick photo, guys.
There's Joe Biden here. This team code. Holy shit, you guys are cooking with the usernames.
Yep, thank you, thank you. We will send the recording out later, either today or tomorrow. No worries, guys. Alright, I want to see everyone's beautiful faces, see everyone's beautiful smiles, please. Thank you very much.
Joe Biden got no cam on his PC. Wasted. Caleb. Okay, no problem. Yeah, no problem, guys. Again, you guys can learn all this online also. So
Alright, I'll be taking the photo now. Remember to smile, guys. 3, 2, 1. Okay, thank you so much for attending our lesson today. I think that will be all for today. Feel free to follow us for latest info and tips. And yeah, that will be all, guys. Thank you so much for coming to MRIC Workshop 2. We hope to see you for Workshop 3. We'll send the recording and slides in due time. Thank you so much for attending this call, guys.
thanks,
Bye-bye.
guys.